Hey guys, Brian's here. Welcome to my YouTube channel. The date in which we are going to analyze is Tuesday, October 8th, 2024. If you're new to the YouTube channel, I highly suggest you press the subscribe button down below. Now, this trading setup has been demonstrated on this YouTube channel since 2020. I'll leave a link in the description down below to some previous examples. This is just the latest iteration or the latest example of this setup. We have a lot to unpack as usual. We're going to take a look at the setup on a 3-minute time frame. So this is great for momentum-based scalpers. We're going to analyze what do you do when you miss the setup in the morning. We're also going to take a look at some advanced metrics to build some context around the trade. So using gamma exposure on the 0 DTE time frame. And then we're going to take a look at the SPX's Trade Engine. This is a proprietary system for quant trading app members. On October 8th, the market gapped up. That is the first criteria or the first prerequisites that you want to take note of if you're interested in this strategy. It requires the market to make a gap up or a gap down. For this example, we're paying attention to a gap up. The second criteria you want to look for is if the previous day was a downtrend. So in this case here, the market had a downtrend on Monday and then it gapped up on the Tuesday. So that's criteria 1 and criteria number 2. Criteria number 3 is if the market gaps up above the 2-day anchored VWAP. So this level that we see on my chart right here is what is referred to as a 2-day anchored VWAP. It is just an anchored VWAP anchored to the previous day's open. We want to have our extended hours turned off so we don't have any extended hours volume in the calculation. It's also encouraged that you use the 3-minute time frame with the extended hours turned off. We want to see consolidation at the start of the day. So the market gaps up, it pulls back, and it establishes a tight range. We want to take note of what happens during this consolidation phase. Volume decreases as the market is compressing. Then when it finally has an expansion in price, that's where we see volume increasing. On top of that, we see the 9 EMA, which is this blue line right here, creeping up. So during this consolidation, it gives the 9 EMA time to catch up to price action from the previous day's close. This is important, and this is why you want to have your extended hours turned off. It's usually a good gauge for by the time the 9 EMA catches up with price action, it's generally going to be a good dynamic level to risk off of if you want to get into the trade early. The way this setup is taught is sometimes referred to as the 9 EMA VWAP crossover, and that I have demonstrated on this YouTube channel before. It is not a strategy in which I created. I learned it from Michael Edwards. The problem with waiting for the 9 EMA VWAP crossover is that sometimes it comes too late in the day, as you might have missed out on an earlier entry for the trade. But that's neither here nor there, and that is also dependent on your trading style. The next thing we want to take note of is look at the characteristics of these candlesticks right here. We can see that buyers are pretty aggressive as none of these candles are sitting at the lows. None of them are closing at the lows. That means every single time bears are aggressive and they try to drive price down, bulls step up and they buy at the ask and they drive price right back up. So these candlesticks do not close at the lows. That is a good representation of the sentiments that's occurring at this level. Now, using gamma exposure, which we're going to take a look at later in this video, we know this is a significant strike, which is 570 on the SPY for this particular day. I first wanted to highlight the characteristics of what you want to look for. It's not a trade in which you have to rush into. You will generally have anywhere from 15 to 30 minutes to decide if you want to become involved with taking the trade. The first criteria is the previous day, was there a downtrend? Yes. Then the next criteria is, do we get a gap up the following day? Yes. Then we want to know, do we gap up over the 2-day anchored VWAP? Yes. Then we want to wait and see what are the characteristics of the candlesticks at the low of the day. Are they being bought up? Yes. These 4 ingredients right here, just by looking at your chart before we add some of the advanced metrics, can already paint a decent picture for what you can expect price to do next. Let's continue with the analysis here. What do we have with volume? Volume decreases during the consolidation. That is what you want to see. Then what happens when price finally breaks out? Do we see an increase in volume? Yes, we do. So this is 1, 2, 3, 4, 5, 6 characteristics of what we can anticipate with price action. This is the videos tab on my YouTube channel. I just searched the word for anchored. You can take a look at some previous examples right here in which I've broken down why the 2-day anchored VWAP works so well. Another example of the gap up strategy, as well as the 9 EMA VWAP crossover. An early example of this setup dates back to 2020. This is a gap up. This is the 9 EMA VWAP crossover. And this, I believe, was the first time in which I demonstrated that particular strategy on the YouTube channel. There may be a dozen other examples of this exact same setup. It happens almost identical every single time. This is the same SPY, but this time we've just changed it over to the 15-minute time frame. So you can see the characteristics again of these candlesticks. They're not sitting at the lows here. This is the first 15 minutes of the day. The market opens here, it sells off, but then it is bought up immediately. It opens here, it tries to go lower, but then it is bought up immediately, ultimately closing over VWAP. This gray dynamic level on my chart here is the standard VWAP indicator that ships with almost every charting platform. We see as price breaks above VWAP and closes above it and holds, these are the candlesticks in which the volume is increasing. When it starts closing over VWAP, this is where you have a dynamic level to risk off of, meaning you're looking to place your entries around here and you're essentially willing to risk if the candlestick closes below VWAP, or you can set your stop loss for if price closes below the low of day, or you can use the 9 EMA for if price closes below the 9 EMA, that is where you take your stop loss. On a day such as this, let's just say your average entry is around here. Look at where's the first candle that closes below the 9 EMA. It is all the way up here. All of these candlesticks are being bought up above the 9 EMA. This candlestick touches VWAP and it's bought up right away. This is the characteristics you want to see if you are a buyer. These additional levels that you see on my charts are provided from the Quant Trading app intraday script. Link is in the description to Quant Trading app if you'd like to learn more, as well as the 2-day anchored VWAP. It is part of the same script. It's one study that plots all of these levels on my chart. Now let's take a look at some gamma exposure levels. These levels that you see on my chart, I plot at the start of every week. If you are new to my YouTube channel, head over to the volumes tab, search prep, and you should check out this video right here that I did last year on how I prep for the week using gamma exposure levels. It is the same approach I take every single week. So this day here was Monday, this was the Tuesday. At the start of the week here, I plot these levels on my chart and I leave them up for the remainder of the week as they provide a decent structure or a decent blueprint for what I expect with price action. This blue range right here is what I call the open interest heat map. So it is just an area of where there is the highest concentration of open interest for the week. More information on this approach is explained in this video. In the Quant Trading app Discord, you guys know at the start of every week here, this is where I share those levels. This is where I get it from. So it comes from the Quant Trading app Advanced Gamma Exposure tab. I select all the expirations for this week. So Monday, Tuesday, Wednesday, Thursday, Friday. It builds a gamma exposure profile and then I plot these significant strikes on my chart. 570 is a key strike, as we can see right here with these two bubbles. I'll let you guys check out this video to get a deeper understanding. But for now, let's just focus on October 8th's price action. 570 is the strike with the highest amount of negative gamma, which we just saw on this graph right here. Here is the 570 strike. So that's why it's drawn out on this chart. The AG is just letting me know that this is the strike price that has also the highest amount of absolute gamma. The market's gapping up over this level and then holding this level for the opening drive, as well as the first 30 minutes of the day, is significant. You can think of this as a line in the sand. If price action is above it, then it means bulls are relatively in control. If price action is below it, then bears are relatively in control for the context of this week. It is also the strike that is pretty much right between this open interest heat map. So it's a place of neutrality and it is a good defining spot We know when bulls are in control, price will generally gravitate towards the highest positive gamma strike. That is P1 right here. The same thing works in reverse. If bears are in control, then price action heads towards the high negative gamma strikes. As we can see here yesterday, the markets sold off and we went right down to the lower spectrum of the open interest heat map. And this is also the second highest negative gamma strike. And this is where price action stalled out. This is important to know as it adds an extra layer and an extra level of context to your analysis. We started off simply by just looking at candlesticks as well as the 2-day anchored VWAP, and then just applying some sort of context regarding the setup. Gap up after a gap down day, we are above VWAP, we're above the 9 EMA, we're above the 2-day anchored VWAP. That is context that you can just see on your chart. The gamma exposure is implying an extra level to your trading. These are key strikes right here, but they're not as strong as the solid ones. So that's why I just make them dash. This is just letting us know this is the second highest absolute gamma strike and the third highest absolute gamma strike. But look at the type of price action around these levels. It is relatively choppy versus how it trades when it breaks away from them. I don't really like to take a directional stance around these high absolute gamma strikes. As I don't like making aggressive directional trades wherever I think price action is going to be choppy, as it will drive me crazy. Understanding the characteristics of price action around these gamma exposure levels is beneficial as it can help give you an edge in your conviction for direction, but it can also help with establishing a target. In other words, if you already have all this criteria early in the morning to be long, you can get a good gauge on how high do you think the market is going to go for this particular day, or maybe it's a swing trade. In other words, if the highest positive gamma strike was all the way at 575, maybe you'll tell yourself you'll get long around here because you have the setup on your chart, but your final target might be all the way up at 575. You know to take profit at 573 because this might be another significant strike. You're essentially creating a plan for the trade. You know where you're willing to stop out. It could be if price action breaks the low of day. It could be if price action closes below VWAP, or it can be if price action closes below the 9 EMA on the 3-minute time frame. Those are all 3 different exit strategies for 3 different styles of traders, and it's all based on what your expectations are. If you are getting long at 570 and you're looking to close at 575, that is essentially 50 points on the SPX. That is a decent trade. In my opinion, it is an excellent trade if you're looking for a profit target of 50 points within a day or 2. And the reason I'm bringing this up is because you want to define what type of expectations do you have for a trade like this. If it is a trade in which you're only expecting 10 points on the SPX, which is about $1 move on the SPY, maybe it's not enough of a move for you because it's too small of a scalp. Now, if you're a micro scalper, 10 points on the SPX is an excellent trade if you're looking to be in and out of that trade in under 15 minutes. These gamma exposure levels can help define these targets for you. Now, what to do if you miss the trade? This is something I've demonstrated also in those other videos highlighting the 9 EMA VWAP crossover or any other type of momentum-based strategy. The 50% retracement using the Fibonacci tool is my preferred choice of method for if I miss the momentum scalp in the morning, or if I was hesitant, or if I still didn't have enough conviction regarding the setup. You simply start your Fibonacci at the bottom of the day, so the low of day, and you just trace it as price action is moving up until it has its first major pullback. In other words, right here is where it had its first real pullback. As this first 15-minute candle is forming, you're not really trading during this time here. You're sitting back and you're waiting for price action to develop. So that means you start from here. The next 15-minute candle is the push. This is the one that's giving you some sort of confirmation that there is some sort of momentum happening for the day. We saw the increase in volume on the 3-minute time frame. Price action broke over VWAP. We get the 9 EMA VWAP crossover that happens a little bit later, so you're getting all these signs. But where does that 9 EMA VWAP crossover happens? It happens later in the morning. So right here, this is our push up. This is our 50% retracement. This is the next leg up. And look at where buyers show up aggressively. Again, it is at that 50% retracement. That is the equivalent of right here. This is our push up. This is our 50% retracement. This is the next leg up. It happens after the 9 EMA VWAP crossovers. So let's just say you are the patient trader that likes to wait for the 9 EMA VWAP crossover. You want to also see that 50% retracement, and then you want to see the characteristics of aggressive buyers while it's happening. Look at this hammer candle that forms. Look at all these wicks that are happening at the bottom of these candlesticks. This is the criteria you want to look for, because it means your risk is small. The trade is not always going to work out exactly like this. It means if you enter around here and the next candle breaks down below VWAP and you take a stop loss, you're maybe taking a 25 cents, a 50 cents stop loss at most on the SPY, which is about a 5-point stop loss on the ES or a 5-point stop loss on the SPX. For an options trader, that's not really a big hit. It might be a 5% or 10% loss depending on your strike selection. And if you're an options trader, you're essentially looking for a 50% profit target. So if you're risking 5 to 10% to potentially make 40 to 50%, it is well within a good risk to reward parameters for a 0 DTE trader. I'm using this 50% retracement to apply additional context as to why this can be the next area of entry. We have the 9 EMA, we have the intraday VWAP, we had the 9 EMA VWAP crossover, we're trading in the direction of momentum for the day, and we have the 50% retracement. All of these things match the criteria or the textbook trade that I have demonstrated for this strategy over the years. The gamma exposure also applied additional context. On top of that, this is the high of day. So right here is the high of day. Whenever price breaks out of the high of day, when it retraces back to the high of day, that is also an area of additional confluence. It works the same in reverse. If this is the low of day and price action breaks down below the low of day, if it retraces back to the previous low of day, this area is likely to act as resistance and price will continue down if there was a lot of momentum to the downside at the start of the day. However, for this video, we're just focused on the long setups. Now, what happens if you still hesitated or you still fumbled and you didn't execute properly on this trade? You'll generally get an afternoon setup. So let's just say you are a West Coast based trader and you generally don't trade the first 3 hours of the day. Is there a setup for you in the afternoon? And the answer is yes. The afternoon for East Coast traders can be the morning for West Coast traders. And this is where we can sometimes see a second 50% retracement. This is the low of day. We just extend our fibs all the way up to the high of day before we get the first major pullback. And in this case here, it creates what other traders call the golden zone or the golden pockets. I drew it out right here. And it's just another 50% retracements. Again, look at the characteristics of the candles we see here. These long wicks, it is showing who is being more aggressive in that time frame. Any of you quant trading app members that were on the webinar hosted a couple weeks back, you guys at this point should have remembered the chapter in which I dedicated towards these types of candlesticks. If you're not a trader that knows how to read the tape that well, or you get overwhelmed by level 2, and by tape, I'm referring to time and sales. If all of those numbers flashing on your screens overwhelm you, you can keep it simple by looking for characteristics in the candlesticks forming around key zones and key pockets. So this is a second entry. Your profit target at this point will essentially be where price broke down from. So from here to here is the short-term scalp. The high of day is the second target. We won't always get the breakout again for the Fibonacci extension up here, but these are just potential profit targets that are outlined from just using the Fibonacci's. Now, why the gap over the 2-day anchored VWAP works so well has been demonstrated in a video on this YouTube channel. I will leave the link in the description down below as I highlighted it earlier in this video. But a lot of it is coming from the volume profile. If this is the previous day here, there were a lot of shorts that were expecting some continuation to the downside. The following day, when the market gapped up, this was a lot of traders that were trapped on the wrong side, stopping out right here. The market opens, they are in trouble as price has not rolled over. It has not gone back down here, so they are the ones that are in trouble. And whoever is in trouble is not going to be patient. They are going to be aggressive with closing their positions. If a bear is closing out their position, it means they are buying the underlying back, and that's going to help drive price higher. We can see this on the volume profile. We can see where the point of control was for the previous day. The market gaps up into this area where there is a lot of expected supply from the previous day, but that supply is being absorbed and the market breaks out. It comes back into this area of supply. Buyers are here to meet price. We get a push higher. Again, the psychology behind this has been explained in greater detail in another video. I just wanted to include it in this one to remind you guys. Any trader of the S&P 500 should always have eyes on the NASDAQ, as tech stocks are a large component of the S&P 500. This is the Qs on the 5-minute time frame, and we want to see similar price action. So this is October 8th, 2024 for the NASDAQ. Look at the characteristics of the first 15-minute candle. Look at the characteristic of the next 15-minute candle. Did it gap up above the 2-day anchored VWAP? Was price above the intraday VWAP? Yes, yes, and yes. This is the NASDAQ on the same day on the 3-minute time frame. Did it gap up above the 2-day anchored VWAP? Was the previous day a downtrend? It's all the same criteria. Look at the volume during the consolidation in the morning. It was decreasing and then it increased and it spiked once price spiked. This setup provided an even easier context as the 9 EMA was a little bit closer to price action. The NASDAQ also did not sell off as much as the SPY. The 2-day anchored VWAP was also right there. So I would argue that this was actually even easier to see, which means the opportunity was also in the Qs. You can take the trade in just the NASDAQ, you can take the trade in just the SPY, or you can take the trade in both. I will often default with the S&P 500 because I'm simply more comfortable, but I do know a lot of traders that prefer to trade the NASDAQ also. The same thing would apply for you. You would want to have the SPY up and you want to see similar characteristics between both charts. Because if there's any divergences between the charts, then it might mean that the trade might not work out as clearly as you would expect. When the SPY pulled back to 50% retracement, the NASDAQ did not at this point, but look at the characteristics. Look at how the candlesticks were all holding above the 9 EMA until about after 11 a.m. Eastern time. This was the first close below the 9 EMA. That means for any entry around here had a decent move before the first clear sign to stop out of the trade there. Similar to the S&P 500 traders, if you miss the trade in the morning, is there an opportunity later in the morning or later in the afternoon? And the answer is yes, as this is the same 50% retracement. This is the low of day. You're just tracing the Fibonacci's until we get the first real pullback, which is all the way up here. You leave this alone until price action comes back to this 50% retracement zone. In other words, at this point in time, right here, you would have already be aware of where buyers might be aggressive, and you're just waiting for these candlesticks to close. You're just waiting for price action to finally come down to an area in which you're interested in being long. Now let's focus on some 0 DTE gamma exposure as an extra layer of what to expect on these days. This is a snapshot of the gamma exposure for the SPX from Quant Trading app 15 minutes after the market opened. The first thing we want to take note of is where is our highest positive gamma. It is right here at 750. We can also see in the background here that there is a ton of sentiment and traders on the call side, as this is all of the volume. That's what the lightly shaded blue area is in the background. It is all of the call volume around these gamma exposure strikes. On the put side, we can see all the put volume down here. The put volume is relatively spread out, whereas there's a stronger concentration of call volume. The SPX at this point in time is in positive gamma territory. We can see all of this is the high positive gamma. This is our negative gamma on this side. It pales in comparison to all of this positive gamma. This looks like a mountain. This looks like a couple of hills with some small valleys here and there. At first glance at this early in the morning, you should clock this, clock the volume. What might be an obstacle in the way? It might be this strike right here. As price has to climb up to this one, it has to hold above this before it heads to this one. This strike is 730. And this is for advanced traders to apply more context to your chart. You can tell yourself, hey, if the market can hold above 720, why 720? This is where a lot of the high positive gamma is. This is also the strike that has a lot of negative put volume also right here. So it is a significant strike for both calls and puts. If price can hold above 720, it's likely to head towards 730. If it can hold above 730, then the profit target is 750 right here. This is the archive gamma exposure tab on Quant Trading app. So what we're referring to is this chart right here. It is the same screenshot. And what we're going to do is play this out. We can also take a look at the price action at this point in time. This is 7:30. Look at where the first rejection happened at 7:30. 15 minutes after the market opened. So that means at the close of this candlestick right here, we are already aware of where there might be the next level of complications or challenges for bulls, and it's 7:30 as it's very clearly to see right here. So this rejection should not come as a surprise. It should also not come as a surprise as where did the market close? It closed right at 750 because a lot of traders at this point are going to be speculating the same thing. We can see it right here. A lot of positive gamma, a lot of volume coming into that 750 strike. We can see the gamma exposure profile as we've seen hundreds of examples of this. This is an extra step. We started with the 9 EMA VWAP crossover. We started with the gap up. We started with the 2-day anchored VWAP. Very simple things to take a look at. This is to provide additional confluence to build your conviction in your trade or to help you hold the trade for your larger target. There's nothing wrong with taking a scalp from 720 to 730, but if you can create the opportunity to potentially get a trade up to 750, that's even better for yourself, because this can help you for when the market pulls back in the afternoon to this 50% retracement. You know that there's still potential for us to go up to 750, as earlier in the day there was a decent amount of speculation around 750. This is already a setup that you can take without gamma exposure. The gamma exposure is telling you, hey, this is probably something you might want to take a swing at. Maybe run a 0 DTE out of the money butterfly, as the risk is going to be so low. The return on a 0 DTE butterfly like this could be anywhere from 300 to 600% depending on how narrow you make the butterfly. In a butterfly like this, the debit might be under $3, especially if you're catching it all the way down here. It could even be about $1.50, sometimes even $1, again, depending on how narrow you make the butterfly. So you're essentially risking $100 for one butterfly to potentially make anywhere from $300 to $500, especially if you hold it into that last 15 minutes of the day. This is massive opportunity. At this point in time, it was about an hour, hour and a half, and this is where we can see what did the gamma exposure look like. So as we flash forward or just scroll forward in time, we can see how the gamma profile transpired as the market was moving, and here we go. So this right here is 1 p.m. Eastern time. We still see a huge spike in positive gamma. This profile still looks pretty healthy. So it's not far-fetched to still think that a move like this is possible on a day like this. I can just cipher through this if you're curious. So this is, again, 15 minutes after the market opens, and we can just bounce around and see what's happening with the gamma profile. We can see that this level is growing. We can see right here the market is going up. It's going up. It's at 740, 740. Hovering around 740. This is where it's choppy. It pulls back to about 730. At this point, this is our absolute gamma strike. So now this is likely to act as support. This is still a potential target. We can see that it's holding 730. It's holding 730. It bounced off of 730. It's at 735. This is now 2 p.m. Eastern time, so still a couple hours left in the day. It's pushing, it's rallying 740, 743, 747. It rejects off of 750 as expected, as it should. And then we can see it bounces up to 750, breaks a little over 750. And then in the end, we end up closing right around here, which is about which was to be exact about 750 and 69, or so about 751 or so, anywhere between there. That is essentially a pin at 750 if you trade butterflies, or if you traded the 0 DTE out the money 750 call. Massive opportunity here. Lastly, let's conclude this video with the quant trading app 0 DTE Trade Engine. This is a snapshot of it at the end of the day. It's taking almost all the information we've assessed and put it into one chart. And I pull those images from Quant Trading app. I put them into one video so we can watch this back and see what happened in real time, what was happening, as we have these snapshots at every given moment with all of that data on one chart. This also applies additional context for members in Quant Trading app. Within the Discord, it's right here, guys, under SPX Trade Engine, the SPX data tab. It has the 0 DTE gamma exposure. It also has the 0 DTE Trade Engine that's populating every 5 minutes. It's caching all of that information and sending it into the Discord so we can see any major changes that happen every 5 minutes. This is October 8th right here. This is the timestamp here. I'm just going to play this out. So this is 10 minutes after the market opens. One thing I want to point out is this is our jump in the absolute gamma. So we can see the absolute gamma started down here at 5,700, but it jumped up to 750. On top of that, the power strike. This is a proprietary quant trading app level that is trying to calculate within a 5 to 10 point radius where it's expecting the SPX to be during power hour, and then it's also trying to calculate where it thinks the market is going to close at. The more time passes by in the day, the more accurate it's likely to be, because obviously very early in the morning, how can one guess exactly where the market is going to be during power hour? With more data, more time, there's more information that the trade engine can calculate and compare to previous days to try to come up with an estimate. What's important here is that the absolute gamma strike also jumped up to 750. It pulled back, but at this point, that's already giving us an early sign of, hey, later in the day, I want to keep in mind 750 is a very possible target. It's also not at a random level or at a level that is pretty extreme like 780. 750 is well within a 1 standard deviation move for the SPX. That's what's right behind it here. This gray level is the +1 sigma close. You see we're down here, we have the -1 sigma close. So in other words, it's saying within a 1 standard deviation on a day like today, that is where the SPX will generally close at within a 1 standard deviation. So to the downside and to the upside. From the options markets, this is the +1 expected move from the open. So the standard deviation close for the day is a little bit greater than the expected move. The expected move is coming straight from the options chain. Whereas this 1 sigma close, it's quant trading app's own way of calculating where the market usually closes. If that's confusing, don't worry about trying to memorize that. The point in which I'm trying to show is that 750 is a normal move for the market. If the power strike was all the way up at 5,800, and the market is all the way at 5,720, that's 80 points away. That's where I would pretty much ignore the power strike. But it's the fact that the power strike is pretty close to a normal move for the SPX. This gray zone right here and this red zone right here is the expected move for this 15-minute time frame. So it's also within reach of 15 to 30 minutes or so. It's not too far from price action. That is the whole point. If you're new to QTA and this is your first time looking at any of this, the point is to not become overwhelmed and just ask yourself, is this practical? Is this realistic? Yes, that's what this is answering. The power strike is a practical strike here. It is reasonable as it is not too far away. Is the absolute gamma strike in confluence with it? Well, it gave us a flash, but at this point in time, it's not. So let's play it out and let's see what happens. So now market continues up. We hit the expected move from the open and it struggles a bit here. This is to be expected, but look what happened to the absolute gamma strike. It has now jumped up to the power strike and they are in confluence with each other. Let's let this play out. This rejection at the expected move from the open. Again, this is what we should see here. This is expected to act as resistance. Price is consolidating around it. The absolute gamma strike is still holding with the power strike. I've told you guys this many times before. Whenever these two are in confluence with each other, especially after the morning session, that will generally be a good setup for a 0 DTE butterfly. Obviously using your own risk management, if you're going to hold it until power hour, if you're going to hold it until the last 15 minutes of the day, or if you're going to let this expire, make sure you do your own due diligence, do your own research, make sure you have your own risk management in place. Now it's 1 p.m. The absolute gamma strike has dropped, but it should hold as support, as any of these gamma strikes do. I'm pretty sure if we go check the gamma exposure profile, we will see at 7:30. This is also a significant gamma strike, but let's just continue to play it out here because I would like to conclude this video pretty soon. And we see the absolute gamma strike did jump back up. We're now about to enter power hour. This is now power hours, so there's only 50 minutes left of the market open. We're at 7:45, so within 5-point radius of that power strike as well as the absolute gamma strike, and we can see this consolidation here. Price is compressing around it, as again, this is all to be expected. And there we go, we have our close. This is it again, back on our standard thinkorswim candlestick charts. The trade engine graph and the gamma exposure applies extra context to this chart, as we can only see it in 2-dimensional. That is a 3D view of what's happening underneath the hood. but more than half of the information we needed to know was already on our chart. And the point of this video was to layer the information I shared 4 years ago, and throughout the years, the same setup, the same information, the same tools, how we can add more to this setup to build conviction, to hold for bigger trades, as well as establish setups for what to do if we miss the trade in the morning, or if we are hesitant and we don't like the morning volatility, if you prefer to trade in the afternoon, if you're on the East Coast, if you're on the West Coast, if you have a full-time job. Every trader is different. Every trader has different expectations for the market. I just wanted to provide as much as a full context or a full rounded picture using a 15-minute time frame, the 3-minute time frame, looking at the volume profile, looking at free tools, as well as looking at premium tools with Quant Trading app members, as well as looking at proprietary tools from Quant Trading app. Just wanted to show you guys a full spectrum in a longer form video that I haven't done in a while. If you enjoyed this video, let me know in the comments down below. If you're interested in Quant Trading app, also known as QTA, link is in the description down below. Like the video, share it, and leave a comment if you learned something. Thanks for watching, guys, and I'll catch you in the next one.